Want to make smart investment decisions like who does it right? Well, today we're trying something a little different.
Okay.
We're going to explore how looking at your investment strategy through the lens of supply chain management
Interesting.
can help you make better decisions.
I like it.
So it can provide a lot of insights and really make complex financial concepts way easier to understand.
That's a good goal. A lot of people struggle with that. It is.
Yeah.
It's a good approach.
Okay, so let's just dive right in.
Okay.
Where do we even begin with this whole investment supply chain thing?
Well, just like any well-run supply chain, you got to start with a plan.
Makes sense.
What are your investment goals? Are you looking for like quick short-term wins or more focused on long-term growth?
Okay, that's kind of like how,
Yeah,
you wouldn't stock a warehouse with just random stuff, right?
exactly.
Got to know what you're going to do with it.
Exactly. You've got a plan. And you also need to think about, in addition to like your investment horizon.
You need to think about your risk tolerance. How much volatility can you actually stomach?
Ooh, yeah. I see what you're saying.
This is really crucial because how comfortable you are with risk is going to really strongly influence the types of assets you'll want in your portfolio.
So figuring out my investment horizon and then my risk tolerance is that like a business determining their product line and their target market?
It's a great analogy. And just like a business wouldn't put all of its resources into one product, you don't want to put all your capital into one investment.
Right.
You need to think strategically about capital allocation.
So it's like deciding how much inventory to allocate to each product based on like anticipated demand.
Right.
So we need to do some demand forecasting.
Absolutely.
Market.
Market analysis is key.
Okay.
It's your demand forecasting tool.
Gotcha.
For the investment world.
Okay.
You need to understand market trends, economic indicators.
The performance of companies or assets that you might be interested in.
So instead of looking at past sales figures, we're digging into historical stock performance. Economic reports.
Exactly.
And industry analysis.
All of that. And, just like businesses use software for inventory management.
Right.
Investors can use things like predictive models and scenario analysis to anticipate market shifts and make better decisions.
So these tools can help us navigate different economic conditions and kind of adapt our strategies accordingly.
And exactly, just like a company has to be agile and prepared for the unexpected, investors should be ready to, adjust their approach as conditions change.
This is really giving me a much clearer picture of how to approach investment planning. We establish our goals. We analyze the market to forecast that demand. Now what?
Now you got to think about your inventory. Once a company has a solid production plan, they need to manage their inventory efficiently. In the world of investing, this translates to managing your capital.
So it's all about putting that capital to work.
Yeah.
But we also need to be mindful of liquidity, right?
Absolutely. Striking a balance between liquidity and long-term investments is crucial.
Okay.
Liquidity is having cash or assets that can be easily turned into cash. And that's what you need to cover any immediate expenses.
Okay.
If some opportunity pops up, you're ready.
Yeah.
Or if, God forbid, there's an emergency.
So that's like a business having enough cash on hand to pay its bills and keep everything running smoothly.
That's a good way to put it. Now, long-term investments. Those are assets that you hold for a long time, hoping to get a higher return, but they might not be so easy to get to.
Gotcha.
Like liquid assets. Think of it like when a business invests in equipment for future growth, it's a long-term commitment.
So this highlights the need to have a strategy for both short-term liquidity and then long-term investments.
Exactly. And this is where we see the concept of just-in-time capital come into play.
Interesting.
It's about having the money ready exactly when you need it.
Okay.
Whether it's for an investment or an expense.
Sounds like just-in-time inventory, right?
Exactly.
Where like they make sure that the materials arrive just when they're needed for production to reduce waste and keep things efficient.
Exactly. You don't want capital just sitting around. Well, it could be making you more money.
Right.
But you also don't want to miss out on an opportunity.
Right, because you're just, tapped out.
Yeah, exactly.
So we've got our plan. We're analyzing the market. We're thinking about capital allocation. We're thinking about liquidity. What's the next step?
Diversification. It's super important, both in supply chain management and investing.
That's the don't put all your eggs in one basket advice.
Exactly. In the context of the supply chain, it's like having lots of different suppliers. If a company just relies on one supplier and that supplier is disrupted,
trouble.
Everything stops.
Makes sense.
So you want to spread your capital across different types of assets so that you're not too exposed if one investment does poorly.
Okay, so stocks, bonds, real estate, maybe commodities, digital assets.
Yep.
It's all about, making a well-rounded mix.
Exactly. But it's more than just picking things randomly.
Right.
Remember that market analysis? Understanding the correlations between different assets.
Yeah, correlations, that's important.
It's crucial.
Because we want to make sure they don't all move in the same direction.
Exactly. You want to identify assets that are not closely correlated.
At the same time.
Yes. Meaning they don't all, go up and down together.
So if, one sector of the economy, has problems,
right,
then my investments.
Right.
In other sectors might be okay.
Exactly.
It's about building that resilience into my portfolio.
Yeah. You got it. Just like a company tries to reduce risk by having lots of suppliers. Investors reduce risk by diversifying their assets.
I'm really starting to see how powerful this analogy is for understanding and managing my investments. We planned our production.
Yep.
We're managing our inventory and we're diversifying our suppliers. What's next?
Now that we've kind of got this diversified portfolio, let's talk about how to protect it.
Protect those investments.
Yes, through risk management.
Okay.
This is kind of like, when a supply chain has those really strict quality control measures in place to make sure that everything is up to snuff.
Yeah, so how can we apply that concept of quality control to managing our investments?
So risk management is really about constantly evaluating and making sure that that you're taking the right steps to reduce those potential losses. It's not something you do just once. It's an ongoing thing.
Okay, so earlier we talked about hedging being kind of like insurance for your investments. Can you kind of go into more detail on that?
Yeah, so hedging is basically using these financial tools called derivatives to help offset potential losses in your portfolio.
Okay.
So, for example, if you're worried about the stock market going down, you might think about buying these things called put options.
Put options, okay.
Put options give you the right, but not the obligation to sell your stocks at a certain price.
At a predetermined price.
Yeah, even if the market falls below that.
So it's like a buffer.
It is.
To protect yourself from huge losses.
Yeah, exactly.
Okay, are there any other hedging strategies that people use?
Another common one is futures contracts.
Futures contracts, okay.
Yeah. Futures contracts, you're agreeing to either buy or sell an asset at a specific price on a date in the future.
Okay.
And they can be used to kind of lock in prices and, help protect you from the market moving the wrong way.
So the key is to pick the strategies that make sense for my goals and my risk tolerance.
Exactly. You got to make sure it aligns with your plan.
Okay. It sounds like hedging is it's kind of a sophisticated thing to add to my investment supply chain.
Yeah, it adds another layer of complexity.
Yeah. Are there any other risk management techniques that I should know about?
Well, so in addition to hedging, there's this thing called fundamental analysis.
Okay.
And that's kind of like, before you invest in a company, you really want to understand
the financial health.
Yes. Are they in good shape?
Gotcha.
Are they growing?
So it's like a business vetting their suppliers.
It is.
To make sure that they're reliable and they're going to provide good quality stuff. Okay, cool.
Now, there's also technical analysis.
Okay, what's that?
And that involves looking at those historical price patterns and trends to try and figure out, when might be a good time to buy or sell.
So it's less about the company itself and more about timing the market.
You got it. Technical analysts use charts, different indicators and tools to try and predict
those future price moves.
Yeah.
Okay.
Based on how the stock has behaved in the past.
So investors use both.
They often do.
Fundamental and technical.
Yeah, they use a combination.
To make better decisions.
Exactly.
It sounds like risk management is all about being prepared for the unexpected, really.
It is, to a large degree.
Are there any other factors I should be thinking about as I build this supply chain?
Well, it's really important to remember that the supply chain, it's just a model.
Right.
It's a good way to think about things, but it's not a guarantee.
Yeah, nothing's guaranteed.
Right, the market can be really hard to predict.
Yeah.
And sometimes,
unexpected stuff happens.
Crazy things happen, so you can't plan for everything.
So even with the best planning.
Yeah.
And like the best diversification, I still can't.
You can't eliminate risk completely.
Completely eliminate risk. Okay.
Nope.
Gotcha.
It's important you got to be realistic and know that there's going to be ups and downs.
Yeah. Yeah, I can handle that.
We all go through it.
But I can't let my emotions drive my decision.
Emotions can be dangerous in investing.
Right.
Another thing to watch out for is being overly reliant on technology.
Ooh, interesting.
Those robo-advisors and those algorithms can be really helpful.
Right. But they're not perfect.
They're not magic, okay? No, they can help you automate some things.
Uh-huh.
But, you shouldn't just blindly follow their advice.
Right. I still need to understand what's going on.
You still need to do your research.
Okay, so technology can help.
Yes.
But it can't replace my own thinking.
Exactly. It's a tool.
And my judgment.
A powerful tool.
Okay, so technology can help us manage this supply chain.
Yes.
But we need to use it wisely.
Absolutely.
Okay.
Now, even with all this technology, you also got to remember the importance of human expertise.
Okay, so, we might not all be financial experts.
No.
But we can. We can work with people who are
exactly
to help guide us, right?
Financial advisors can be really valuable.
Okay.
They can give you personalized advice and support.
Okay.
Help you come up with a plan, choose the right investments.
Yeah.
Based on your goals and your risk tolerance.
Okay.
Help you navigate all the ins and outs of the market.
So it's like having a team of experts.
Yes.
Overseeing my supply chain.
That's a good way to think about it.
Okay, cool.
Just like a company needs a well-coordinated team.
To run efficiently.
To keep things running smoothly.
Right.
Investors can really benefit from, having some expert guidance.
This has been really fascinating, learning about building this resilient investment. Supply chain. We've talked about risk management. We've talked about hedging, different types of analysis, the importance of technology, but also the importance of humans.
Exactly.
What other key insights should we be thinking about? So we've covered so much in this deep dive.
Yeah, we have.
Exploring how we can apply these principles of supply chain management to investing.
It's been a good conversation.
It really has.
Yeah.
And I'm curious to see, how do these concepts play out in real-world scenarios?
Well, one area where we see this a lot is impact investing.
Impact invest.
It's a really interesting space where investors aren't just chasing returns. They're also trying to make a positive impact.
Ooh, so aligning investments with values, I like that.
Exactly.
But still seeking that financial growth. How does the supply chain analogy fit into that?
It's actually super relevant because it allows those investors to actually see where their money's going and how it's being used and what the impact is.
So they're not just looking at the financial reports, they're looking at the impact on the environment, on society,
all of that,
on different stakeholders.
Yeah, impact investors often use all sorts of metrics and frameworks to assess the social and environmental return.
Ooh, interesting.
Just like companies look at all their performance data in the supply chain.
Okay, so can you give us an example?
Yeah, so let's say an investor is thinking about funding a company that's, developing new agricultural techniques that are more sustainable.
Sustainable agriculture, very cool.
They might use the supply chain model to actually map out that whole process.
The whole journey.
From getting the seeds to managing the farmland to processing the food to, getting it out to consumers.
So it's a holistic view.
It is.
Of that company's entire operation.
Exactly. And at each step, they're looking for those positive impacts.
Okay.
Are they reducing water usage?
Right.
Are they, protecting the soil? Are they helping the farmers?
So it's a much more comprehensive way of evaluating the investment.
It is.
And just like the numbers.
Not broader.
This is really interesting stuff. We've talked about how technology is transforming investing. Are there any specific technologies that are like particularly useful for this approach?
One that's becoming really important is blockchain.
Blockchain.
It gives you this amazing transparency and traceability, which is really important when you're trying to understand the impact.
So we talked about blockchain as being like a secure and transparent digital ledger. So how does that apply to investments?
Imagine being able to follow your money, like literally watch it as it, as it moves from you to the project.
So we can literally see how our money is being used to make a difference.
Blockchain can do that.
Wow. It's powerful.
It is, especially for those impact investors who want to make sure their money's being used the right way.
Perfect. Ethically.
Ethically, yes.
Okay.
And it helps build more trust in the system.
I like it. Sounds like blockchain's making investing more transparent and accountable. This has been a really, really eye-opening deep dive.
It has been.
We've learned so much about applying, these principles of supply chain management to managing our investments. We've talked about planning, diversifying, managing risk, leveraging technology, aligning our investments with our values.
It's been a great discussion.
It really has.
Yeah.
It's helped me see things in a whole new light. Any final thoughts you'd like to share?
I think the biggest thing to remember is investing's always changing.
It is?
So you gotta keep learning.
Keep up.
Yeah, stay curious.
Oh.
Don't be afraid to. Look at things differently.
Okay, I like that.
And remember, you don't have to do this alone.
Right.
There's tons of resources, advisors, even technology that can help you along the way. So be bold, be curious.
Be bold.
Yeah.
Be curious.
Learn as much as you can. And, think strategically, but also with,
with your heart.
With your heart.
Yeah.
That's fantastic advice. Thank you so much for being here today. It's been my pleasure.
And to everyone listening, thanks for joining us on this deep dive into the world of investing. We hope you learned a lot and that it helps you on your own investment journey. Until next time, keep learning, keep exploring, and keep investing in a brighter future.